From time to time, someone will come into my office and they'll be holding a letter from an insurance company. And it's that dreaded letter that comes every couple of years that tells them, yes, you planned ahead and did the responsible thing and you purchased a long-term care insurance policy because you know about how many people need long-term care in their later years. But the premium that you have to pay to keep that policy alive is going up once again. The person holding that letter in my office is nervous because they're thinking, this used to make sense for the amount that I was paying, but I'm on a fixed budget. I have other living expenses. Should I continue to pay this premium? And in years past, the answer was yes, you really should, because I see what happens to families who don't have that extra help from long-term care insurance. And sometimes it's not a medical decision, but a financial one to go into skilled nursing care, the highest level of care where Medicaid might be available in order to pay for that cost of care. But it should really be your decision. If you want to stay at home and you can safely do that and you just need a little extra financial help from the insurance to pay for care, then you ought to be able to do that. But the reality is, this was never a perfect solution for the rising crisis of long-term care because the insurance companies failed to anticipate the number of people who would be living longer, who would be filing claims for long-term care, and they failed to anticipate the number of people who would drop their coverage. They just failed to anticipate a number of factors, so the costs of the insurance keep going up. So my name is Patrick Cauley. I'm with Keystone Elder Law in Mechanicsburg, Pennsylvania, and I wanted to give you 5 responses if you get that letter about rising premiums. Right off the bat, I should say, if you have some sort of diagnosis, maybe the early stages of a dementia, hold on to it at all costs because it's going to be very valuable to you. But if otherwise your health is relatively good, here are 5 ways you can respond to that letter. The first is to look for an option where you could shorten your benefit period. The benefit period is normally between 2 and 6 years. That's what the insurance company says in their agreement with you. They're going to cover costs under other terms, but for that period of time. You could shorten it and say, I don't need 6 years of coverage. Maybe I only need 3 years of coverage. And by doing so, your premium should come down. Now, there's a danger. What if you need just care in your home because you can't walk very well anymore and you need home health to come in or home care agencies to come in and provide care in your home? What if you go into a assisted living or personal care residence and you just need a little bit of help with the $4,500 to $7,000 a month that's going to cost? That insurance, you might be in there for longer than 2 or 3 years and that insurance would help. But if that makes it a more manageable premium, that's one way. Shorten it from 6 years down to maybe 3 years. Number 2, you could look at a shared policy if you're married. So 2 spouses have a policy. They each have a benefit period of, let's say, 3 years. But if one spouse never needs long-term care and the other spouse needs more than 3 years of coverage, that spouse can borrow from the benefit period of the spouse who doesn't need it and then effectively double their coverage. There might be some cost savings there. Number 3 is a longer elimination period. So the elimination period in your insurance policy is the period of time you have to go private paying for your care before the insurance kicks in. An excellent long-term care policy has a 0-day elimination period, meaning the first day you need care to come into your home, the first day you are in assisted living, the policy starts paying. Some policies might have a 30-day, 60-day, 90-day elimination period, meaning you're paying for that period of time and then the insurance starts paying. You could get a longer elimination period, 100 days, 180 days. That's sometimes an option to keep your premium lower in the meantime. My only caution there is what they're doing is shifting the cost to you. That's an out-of-pocket burden. So if it is assisted living care, certainly if it's skilled care, you're going to be paying out of pocket for that 90 days, 100 days, 180 days, an awful lot of money before your insurance kicks in. So if you must, number 4 is just reduce your daily benefit. So the daily benefit is how much are they paying per day. Keep in mind the average cost in skilled care per day in Pennsylvania in 2022 has just been projected to be over $400 every day. And if your daily rate is $200, you're looking at a lot of money out of pocket. So look at what your current daily coverage rate is, and if you're at home, it just depends how much care do you need? How many hours do you need a home care agency to come in and help you with the activities of daily living? Who knows what you'll need? It might just be a couple hours a day, in which case a short or a smaller daily benefit would cover everything you need. But what happens if you need more coverage throughout the day? The insurance won't pay for the whole cost, and that's more money coming out of your pocket. But a shorter daily or a smaller daily rate is one way to reduce your premium. Finally, number 5, sometimes when there's a significant increase in the premium, the law of your state will require the insurance company to offer some other solution. Like maybe they'll look at how much money you've been paying in premiums and they'll just say, here's a lump sum that you have, $50,000. Take it and never pay a premium again. We'll just keep that amount and that will pay out whenever you need care. But of course, $50,000 or whatever that amount might be for you won't last very long because long-term care is expensive, but at least you can stop paying the premiums. There might be some other options to lock in your premium, but I guarantee when you go through what the terms of that deal are, it's going to mean more out-of-pocket costs for you when you actually have the care. So you might lock in your premium, so in future years you're not paying any more, you're not as nervous now, but how much are you going to have to pay out of pocket under that deal to lock in your premium? So if you need any help with this, any further information about this, contact us at info@keystoneelderlaw.com or leave a question under this video and we'll reach out to you. Happy to provide guidance.